Welcome to another episode of Founders Club. Today we're going to be talking to Lane Kawaoka. He is a multiple time best-selling author. He's also got 10,000 units under management, over $2.1 billion in real estate, and we're going to be talking about how you can make passive income investing in real estate syndications. If you have any questions, put them in the box down below. As always, make sure you check out the links in the description. Leave us a 5-star review. And if you like money and you like real estate, hit that subscribe button and we'll see you on the inside. Welcome to Founders Club, the show for real estate entrepreneurs. All right, Lane, welcome to Founders Club and thank you for being on.
Hey, thanks for having me, Oliver. Aloha, everybody.
Yes, and Lane is based out in Hawaii, so we can all be jealous about that. And we've actually known each other for quite some time now. We were just talking about it. I think we met in 2016, and it's been really cool to kind of watch your rise and writing multiple books and all of the things that you've done in the syndication space. So, congrats to you on everything you've been able to accomplish the last few years.
Yeah, thanks. It's been a while, and you look the same, by the way, too.
So do you. I was going to say the same thing. Well, cool, man. So I wanted to kind of start. I know you just put out a new book, and I really enjoyed your last book, The Simple Passive Cash Flow. And so the new book is entitled The Wealth Elevator. And why don't we just start with like, what does that metaphor mean to you, and what is the kind of premise of the book?
Yeah, so like when I started being an engineer, started with, zero, essentially zero net worth, but a decent salary. I bought a bunch of rental properties, and I've come across through this wealth building journey a couple of clear defining moments where the strategies change. It's not a one size fits all solution. And so I came up with this idea of like the wealth elevator where, you're trying to ascend the building as quick as possible, but there's floors to this wealth elevator journey. And, the first I think is defined as the basement level. A lot of people who don't make 50, 60 grand a year, people call these guys broke guys, right? They're in the basement. And I think a lot of books are written for those people in particular, right? Like the Dave Ramsey, Susie Orman books. Very little books were written for guys like myself when I was a non-accredited investor, right? I had some money, and the name of the game was just buying rental properties. But then there was a clear defining moment when I became more of an accredited investor and went to that second floor of the wealth elevator, investing in syndications and private placements, mostly because the rental properties are just a pain in the butt. They're not scalable and they're high liability after a certain point, but part of the journey, nevertheless. And then, we layer on more floors on top of that, 3, 4 penthouse, etc., which you can talk about later. But nobody ever, like, I wish somebody would have told me, hey dude, there's different points and inflection points and there's paradigms of this. And that was kind of the whole construct of the book.
Yeah, no, I love that. And I do agree there's kind of a gap in that middle part of the market of, the people that like you said are on floor 1 versus floor 2 where maybe they've got some cash, but they don't necessarily have the time to be actively investing. And I think that's where a lot of the work you've done in like the syndication space is really big because that's an opportunity to place money with an operator that knows what they're doing and go into deals that are generally better deals, multifamily deals that are a lot safer. So why don't you just speak on kind of how the whole syndication world works, and then we can dive a little deeper on it.
Yeah, I mean, I'm sure your audience has heard, but like the analogy I like to use is like an airplane. And, in the airplane, you've got the cockpit with the general partners. These got the guys who find the deal, they source the lending, they manage the deal, they do a lot of distributions, and they eventually land the plane for everybody who is sitting back and coach all your passive investors, your LPs who invest, and for starters, like 50, 100 grand. There might be 100 of these investors, and they sit back, relax, and they take a nap, and they are able to board many of these planes, right? Allowing them to get diversification in different geographic markets. I know you and I cross paths in Dallas a few times, right? Like that's a very popular hotbed for deals out there in the South. and the Sunbelt states, but also asset classes, right? Like apartments, self-storage, and now we're also moving off into more private equity deals with interest rates very difficult here in the next 5 to 10 years, in my opinion. And you
Mhm.
can essentially use this structure to power and get into more higher quality institutional quality deals.
Yeah, no, I love that. And yeah, that's a great way to look at it. And for those that aren't super familiar, basically a syndication is just like a deal that you can invest in where you don't have an active role. You're just basically a money partner. You get a return, you get mailbox money to where you don't have to worry about anything. It's not like a rental property where you're dealing with any issues. No one's calling you to fix things. You're basically just placing the money and getting, whatever the return profile is on that particular deal.
Yeah, and the
Um,
nice thing too is like when you get to these deals, there's usually a value add component. I mean, we do some ground up development. That's a very extreme example, but you can be doing more light value add, essentially sort of like a long term fix and flip. And going back to the analogy of the airplane, the general partners have skin in the game and they have carried upside. So their goal is to not crash the plane, kill everybody, obviously, but also they want to see this thing go up so they can make more money too. So it's kind of a good, it's a good kumbaya kind of synergy, right? People use this typically where there's an 80-20 split or 70-30 split between GPs and LPs, and those you can structure these a myriad of different ways, but the spirit of the deal, right? Everybody's in this together, right?
Yeah. Yeah, I remember the joke used to always be I would go to these events on syndication and I would ask questions and the answer would always be it depends. And it used to frustrate me so much at the beginning until it started to click that like there is no one size fits all. There's so many different ways to do it. There's so many different types of projects. There's so many different asset classes. So maybe we can just start with like how does someone go about finding a syndication to place money? Let's say that, I've got a little nest egg saved up. I want to deploy it. I want to make money. I don't have a lot of time to be active and hands on. How do I go about finding a syndication? Hey there, I just have a quick favor to ask. If you're getting value from Founders Club and you're watching on YouTube, just give us a like, hit that subscribe button. If you're listening on iTunes, leave us a 5-star review. These things are free to do and it really helps the channel and it also helps us be able to bring better guests for you in the future. Now back to the episode.
Oh, yeah. So maybe I'll just tell my story. Maybe this is a little bit of like how not to do it. But I mean, back in 2015, I had 11 rental properties and I was kind of on this crest of going from the first floor to the second floor of the wealth elevator. Didn't know it at the time. But I met all these accredited investors and they were investing in these types of syndications and private placements, mostly apartments, multifamily, because, obviously it's a step up from single family homes and it's the same business essentially. Whereas, there's self-storage, there's mobile home parks, but a lot of people don't have the working knowledge of, the experience in there. Whether you have never really ran a self-storage facility of your own or even rented one as a user yourself, or even if you haven't owned rental properties, surely you've rented an apartment in college or something like that. So I, started to just it's just network, right? Like there's a lot of crowdfunding websites out there, but I mean, the crowdfunding website is just a broker dealer connecting people with a deal and taking a cut, and they don't have any skin in the game. And there's a lot of like I think that's the important thing. You want to work with people who have skin in the game and are actually real sponsors, operators of the deal. So I had to go to kind of the hotbed of where these operators were. Now the hard part is when you don't have a network yourself and you're a newbie, you're like one of the fireflies going to where the light source is. And these are not necessarily the best operators or deals, right? And I always tell investors like be wary of working with anybody less than $1 billion of past deal experience because they're still relatively new. I mean, 200 million, 300 million may seem like a lot, but it really isn't. I know we hit 1 billion in 2020, and that was where we were able to scale the team, right? A lot of these rungs, you have like the operator, they're doing it themselves. They don't have a team. they may be even still working their IT job on the side, right? And those are the deals I invested with initially. My first 15 deals I went into, maybe a few of them were probably like head scratchers later. Maybe I shouldn't have invested with them or that deal. But hey, that's just, I think that's how you learn. And, maybe investors are maybe not comfortable with that idea, but look, this is not for everybody, right?
Yeah, I think the most important thing you just said right there is finding operators who have skin in the game. You want to invest alongside people that put money of their own into their own deals with you. I think that that's a big red flag if they don't. Now, obviously, there comes a number of deals where that's probably not possible. But in an ideal world, you're finding people that have skin in the game to invest alongside. So, like, where, because there's no like website that you can go to like invest in syndications, right? So, like, how do you recommend people find these operators or these deals to get involved with?
Yeah, I mean, there are some these days, right? But they're riddled with like sponsorship ads and like they just promote the people who pay them the most money, essentially, right? Like they're essentially fake review sites. So I've always, been well aware of that. I know how this game works, right? It's all of this like people are just like playing that game, operators and influencers. So I always was like, all right, well, no better way of learning than to build relationship with other purely passive accredited investors, the people who are actually the data points at the end, and kind of go from there. So I kind of went down the path of, building a community and building a lot of relationships with other passive investors. Now, me being an operator myself, we started to syndicate deals back in 2016 with little crappy Class C properties, 50 units, then 100 units, and then going from there and developing. Like we're operators ourselves, so we can take in the data that the P&Ls and rent rolls, which you, by the way, you never get as an LP. Nor I don't know. I would say you probably don't need it. Most good operators would never give you that type of information. And maybe I'll take, you're saying earlier, right? Like, yeah, I guess you want skin in the game, and there's somewhat of a loose rule of 5 to 10% of skin in the game. But I'll also layer on top of that, like there's a spectrum of operators out there. You have institutional operators that are very reliable, but they
Right.
have worse fee structures, worse splits, where you're not going to double your money in 5 years. Like with their fee structures, it's way less than that. But for some of my clients who are higher net worth, that may be a better option. These guys, they typically have done more than $4 or $5 billion of past projects, right? They're institutional. They have a big team. That's kind of why they have such a big fee structure afloat. On the other end of the spectrum, again, guys under $1 billion of assets, you certainly want to see 10% of the needed equity coming from the lead sponsor. Now there's a zone in the middle, which I call the middle market. Like guys between a billion to several $1 billion of deals who are good operators, have certainly kind of proven themselves through dozens and dozens of deals, but may not necessarily put in more than a few $100,000 their own capital because they don't need to, right? And so that's where I see on these forums people always are writing this crap, right? They don't know, they're not operators, and I'm like, well, if that's all you have insight and knowledge into, then I guess that's one way. But I'm like, well, let's evaluate the deal, right? Let's pull the P&Ls and the rent rolls. That's kind of the problem. People don't have access to that, right? If you have a CoStar or a Yardi subscription, which usually costs about 20-30 grand, you do. But then you also have to like walk and analyze the comparable properties next door, because a lot of these deals you're verifying what you can bump the rents to, and that's kind of where the big due diligence comes in, and then the people component, right? As you said earlier, it's a small ecosystem. A lot of us operators kind of know each other, right? More importantly, what I found are the best referral sources is the contractors that we work with know all the other peer operators, right? Which is how we found some new partnerships here lately. But that's kind of I think that's a different side of what I think most people hear on these podcasts as far as due
No.
diligence.
No, I think the moral of the story there is, in terms of finding these deals, it really is about the network, right? If you know people that are investing in these types of deals, reach out, ask them about it. If you know, people like myself and Lane, like we know a lot of the top operators in the country, reach out, shoot me a message on DM. I'd be happy to refer you to some people. And I'm sure Lane would as well. I know you have a fund as well. So there's definitely, it requires a little bit of outreach and networking, but there's definitely, a vast ocean of deals out there that you can invest in. And
Yeah.
so, that being said, like, how should one be looking at doing due diligence on the operators and the deals?
Yeah.
As
So
let's assume now that, we've got access to the deal, we've got access to an operator. How are we vetting them to make sure that, we feel good about placing our money there?
yeah, I mean, as far as like, it's people then the deal, right? I mean, I'll just say the people part, it's gonna be tough for you guys folks to do if you don't know anybody. I mean, everybody says they've done something, but you don't know. It's unverifiable. So you might as well just throw it out the window. And that's why I say start with the LPs, but that's a long-winded path there. So, I mean, what I essentially did when I first started, when I didn't really know too many people, is I started with the deal because that's something tangible that if you don't know anybody and you're coming at this code, you can start to eliminate some of the duds, right? The people who are being way too overzealous on assumptions. So, the way I break it down, and I have a full course that, if your folks want to get access to, they can reach out for, but the biggest thing is the reversion cap rate. What is the assumed exit cap rate? So what the hell is this thing is? Well, it's super important, guys. So you better pay attention.
Mhm.
This is what you're assuming you're going to sell the asset in the future. The thing is, we don't know what the market is going to be. So it would be a little overzealous to assume that the market has improved since the time you bought it. But you still see a lot of operators doing this. So, for example, like let's just say the prevailing cap rate, I think in like Dallas, it's gone up, right? Because we've had a huge market correction these last several years.
Yep.
So your Class B apartment in Dallas, different submarkets, of course, right? So there's a huge range here. Let's just call it. It's probably trading for a 4.5 cap rate right now these days. I don't know if that's true, but let's just go with it. You may want to see them use an exit cap rate or reversion cap rate of 5, right? Because you're assuming that you're selling it in a crappier market. And that's what that represents. The cap rate is the multiplier that the asset is sold for at the end. If you want to geek out on it, it's the net operating income divided by the cap rate, and that is the market price. So when you're assuming that the denominator is getting bigger, the market price gets smaller. So that's the
Very
relationship
important
there.
calculation. Yep.
Yeah, it took me a long time to like really get it straight in my head too. So don't be worried if it's confusing. But what you see a lot of institutions will do is if they're buying it in a market of a 4.5 cap, it doesn't matter what the property is. Don't get that confused, right? This is different. This is what the prevailing market cap for that asset and that submarket is. They're buying it in a 4.5 environment, they may assume that they are going to sell it in a 4 cap, a better market in the future. And that might happen. But if it doesn't, then the property will probably underperform the projections by maybe half or a third. So these are one of the big things to spot check as an investor when you're going to the deck. Hey, what is the reversion cap rate? What is it in comparison to the prevailing cap rate today? And it's the next thing to look at is like, well, what are assumed occupancy rates, right? Like you never run an apartment at 95%, occupancy. That's not possible. I mean, it is
Mhm.
theoretically possible, but you don't do that, right? Because you're always trying to maximize the rents at the same time. So, what are they using for full occupancy? Is it 95%? Ideally, maybe they use on at 92, right? So these are the things to spot check for. Essentially, what I'm trying to do for investors here is like to teach it in a certain way where, look, you're not going to be a freaking underwriting expert on this stuff, but there are certain things to spot check before you go and buy the car. And that's my analogy. Is like I
Yep.
don't know anything about cars, guys. I drive a F-150. but I don't know any. I'm not a car guy. It's all freaking electronics anyway. So who knows these more modern cars? But if I were to buy a car, or especially an exotic car, which I hope to do one day maybe, I would take it to a mechanic and I would have them inspect it. But if I'm too cheap, like how I am, and I want to spend the $5,000 to get it inspected, I would spot check a few things or have my buddy come over and help me spot check a few things. And that's essentially what, at least for starters, when you're
Yeah.
getting started, this reversion cap rate is kind of like checking. I don't know. I don't know. I don't know anything about cars, but you're checking that one thing that is probably broken and is an indicator of other things in the underwriting.
Yeah, no, I totally agree with that. I think that, you obviously don't need to know everything, but you just need to know enough to be dangerous. And I think that reversion cap rate is a critical piece. I think the occupancy piece is a critical piece. And then also, what are they saying is market rent, right? That's another thing that you can easily cross verify by just looking around on the market on like, apartments.com and all the other websites and just see, are they like saying, each unit's going to rent for 2,500 a month, but everything you're seeing on the market is 2,200 a month. That's another easy
Yeah.
thing to spot check to evaluate the performance. Hey, real quick, we are growing our nationwide real estate team and we are looking for agents and brokers who want to be a part of it. When you join our inner circle, you'll have access to private trainings, 100% commission real estate plans, stock awards, and the ability to refer agents to build a downline for passive income. Best part is you get 188 pieces of print marketing collateral for free on every listing to help you sell more homes. To learn more, visit 100commissionrealestate.com. That's the number 100commissionrealestate.com, or send me a message on any of my social media accounts. Links in the description below, and we'll look forward to talking to you. Now back to the episode. Evaluate the
It,
performance on the
it's
deals.
hard though. That one, I mean, you're exactly right that is one of the biggest drivers, other than the reversion cap rate. What the hell you're renting these units for is the biggest driver in the numbers by far in these deals. But I think for LPs, it's hard. These internet marketers with their pictures, like it's really hard to capture the quality of those units because they're always showing the good ones, obviously, in the pictures.
Right.
Unless you get your ass over there and you actually walk the units and then secret shop the other units, you don't know, right? And this is where, like, I mean, a lot of times we'll have the renovation budgets, so we have a good idea what the subject property is. And then we also will get tipped off by the broker who may have sold the comparable property or one of the comparable properties to get data points. And then we also have the CoStar data on this, which is not perfect, but I think like if you just have relative values to each other, it's good. It's pretty good when you have at least one insight into data into one of the properties. So like it's just like kind of like Zillow, right? I think we have a lot of more experienced agents here that understand Zillow. Everybody says Zillow's garbage. I mean, I guess it kind of is, but if you use the data as like, okay, at least it's like a relative measuring stick that all properties are based off of, right? In, and I think that's the way we use CoStar, right? Like we're not taking it as gospel. We need to go there and do physical due diligence and check the subject property and the comparables. But it is a quick and dirty way, at least when we're looking at, people always say, oh, I look at 1,000+ deals. Bullshit. You really wasting your time with that type of stuff? But no, there's these quick things you do just to like take out the
Yeah,
deals
and
out
I
of the way.
agreed. And I think that was my point. Like, is you can obviously go deeper, but you want to check if it's way out of line. Like I was looking at a deal outside of Arizona near a college, and the guy was projecting 1,500 a month rents, and I couldn't find a single unit in all of in the entire market that was over 1,300. So I'm like, how are you getting to this number? Even like the ultra premium stuff was at like 1,300 for these one bedrooms and studios. And so it's just finding those little things, to your point, spot checking those things, and just making sure that nothing stands out as like a red flag.
Yeah, yeah. I mean, it's good to, if you're an investor, you have to kind of, yeah, this is reasonable, right? But I think sometimes investors who are not very, they think they're sophisticated, but they're not. Those are kind of the worst investors because they dig in there and it's like, you know, at the end of the day, you got to do physical due diligence, right? And that's what we typically will do after we've gone through all this initial stuff. But the initial stuff gets us pretty dang close, right? Because we've done this so long and we've owned and operated dozens and dozens of properties ourselves. Um, and I think that's like, that's I think for operators, that's also a cheat sheet too, right? Like you have your property management companies that you work with, and you inherently engulf all their data too. So that's a huge leg up that I think operators and sponsors have over the little LP who has absolutely no insight into what things are renting out there and the market.
Yeah. Yeah, property managers are another great source. Make a couple calls to some property managers and see what they think. But just finding those, anything that sticks out, that's obviously the things that you bless the deal, check the operator's track record. And then that's kind of like, the next step is like evaluating like the return profile. Like what do you target as a syndication, or what would you recommend people look for as like a return profile that would be exciting?
I mean, it to me the return profile doesn't really matter if all the assumptions are BS anyway, right? Like,
Mhm.
yeah, you don't want to invest if it's under 14% IR. That's just not worth it. But I guess my whole point is like if the operator is using a bogus reversion cap rate, even if they say they're going to 150% your money in 5 years, when you down regulate it and you underwrite it for real, it may only be a 60% return in 5 years. And at that point, it's no bueno, right? So
Mhm.
I think that's what I'm saying as an LP. You should be able to at least normalize the projections, upregulate it or downregulate it based on what they're using as the assumptions and inputs that drive the model, right? Like, I mean, you may not be able to, I mean, it's a little bit harder to do the sensitivity analysis in your head if for the rents are off by $50 across the board. But, a general rule of thumb is if they're being aggressive on the reversion cap rate by 0.5%, that's a movement of like 30-40% on the projections. So what that means is if the operator is saying, yeah, we're going to double your money in 5 years or 100%, and you normalize it to more of a regular reversion cap rate or more of a appropriate one, right? Because it still is always a risk and a gamble and a guess of what that reversion cap rate is going to be. Well, if you down regulate it in that example, that 100% return is going to go down to like 60% or 70%. So then now like you compare with the operator who was a good Boy Scout and was using the right numbers. Now their 85% return in 5 years that you originally were like, nah, that sucks, is actually the better deal at the end of the day. So that's where I'm like, well, just, even though some of these deals have a little bit nicer bows and packaging around it, you know, y- this is what makes this hard for LPs is trying to equate all these people. And some people are kind of cheating at the end of the day.
Yeah, no, I like that. And I like what you said about, back to the assumptions. As long as the inputs are correct, that's where the real kind of rubber meets the road. And then I also heard you say kind of anything below 14% IRR is not exciting for you. So maybe we'll use those as the targets. Um,
I mean,
but what about
if it's an equity deal, I mean, it better be higher, right? But if it's a debt deal, then like, yeah, 12 to 13% is probably the range. There are preferred equity deals that are kind of a hybrid between the two. Maybe that's like 12 to 15% these days. But, I think everybody is where it gets complicated for investors. Every investor needs to figure out, well, how much do I want out of my portfolio in real estate? And of that, how much do I want it in debt and equity side?
Yeah. Yep, totally agree. And then what about like timelines? Like how long should someone expect to hand over their money for? What are you seeing in terms of like average length of time for someone to, put their money into play before they kind of exit the deal?
Yeah, usually like 3 to 5 years, the assumption. But the bad thing about these deals is that they're liquid, right? You can't sell the asset, right? Especially
Right.
in a down market. But at the end of the day, you got to look at what the business plan is. If the business plan is to go through 80% of the units and renovate them, normally you don't want to try and kick people out and drop your cash flow in the interim. So you're just doing it as a natural turnover happens. So majority of the units you can get through in a couple of the years, maybe add an extra year on there, right?
Yeah.
So ideally, if you're investing in a good market, and you can get in and out in 2 to 3 years. I mean, we've done that ourselves, but that does require a little bit of a nice trade wind behind your back to do that.
I would agree. And I always tell people assume it's at least 5 years and better off to assume it's 10 because at the end of the day, if the asset is cash flowing and you're getting money on it, if the market turns or something happens like we've seen the last couple years, like just sit on it, right? Like sit on it longer. You don't want to exit just for the sake of exiting. You want to exit for, the biggest amount of profit possible. And so I think that just assuming that this is a long-term investment is the best way to look at it. Like don't, to your point, it's illiquid. Don't put money that you're going to need in a few years. This is basically like set it and forget it type money.
Yeah, and you're exactly correct. And so make sure the debt aligns with this mentality because a lot of deals, majority of deals people did in 2021 on were with bridge debt. And we've done deals like this ourselves, right? And when you go in with bridge debt, so debt, I would say under 3 years is considered bridge debt. Your loan, comes up for
Yeah.
renewal. And if
Yeah.
the market crashes on you, which it did, you're stuck. You're screwed. So
Yeah.
the way to mitigate that is to only go into deals with longer term debt. 5 year to 15-year max is kind of the loan terms on these things. But it's going to be a lot more costly. Your return prospects are going to be a lot less. And that's the trade-off. But that's the lesson learned written in blood, man. Us and everybody included. If people don't own up to it, they're lying. But
Yeah.
that's kind of where you need to diversify and understand as an investor. All right, if I want a little bit more upside, the bridge loan path in the right market is the way to go. But if not, I need to stick to more 8-year term debt, 7-year term debt and greater. But your return ROI numbers aren't going to be there.
Yeah. No, totally agree. And then just kind of on that note, like how should we be looking at, protecting ourselves in market downturns? Obviously, I like what you said about longer term debt. I think that's a no-brainer. I mean, that was one of the biggest lessons I've learned the last couple years is even if it costs more, get the long-term debt because I don't think there's ever been a 10-year downturn, right? There might be a downturn of a year or two in between, but as long as you've got everything in place to ride it out and the property's cash flowing, you're generally pretty safe.
Yeah, but this is where like passive investors are able to some but be transitory in this nature. Like you should be investing in multiple deals. I mean, you need to get diversification. Like the biggest thing that happened this last market correction didn't matter what market you're in. It's just the vintage, right? Like it's kind of like if you're a winery, if you had a fire coming through your grape fields, your 2021, 2023 vintage is going to be junk, right? You're going to have
Right.
a lot of rosé wine that nobody wants. And same thing here. If there are market corrections from 2009 to 2022, it was smooth sailing. It was a great time. I think you and I met in the golden era of apartment investing, the 2016 vintage. That was a great wine in terms of real estate back then.
Yeah.
Um, but there are market cycles, and you never know when market cycles happen, but they're different in every asset class. C- Commercial real estate went through a bigger correction than in 2018 or 2008. Stock market is all-time highs, and I don't do stocks, and maybe I'll miss out on the next best 5 years in the stock market. But I mean, I'm kind of taking an approach of I look what's beat up and I kind of go to that, and I zig when everybody is zagging, and that's kind of, you know, take that into account, right? None of this is investment advice. Not licensed to do
Right.
that. Not licensed to sell marketable securities to people. But that's something to think about as an investor, and this is also why we play with private equity too, right? It's on a different market, different asset class, so different market cycle too.
If you're looking for a little bit of extra help growing your real estate business or brokerage, make sure you check out my consulting links in the description below, and I'll work one on one with you to give you the help you need. Now, back to the episode. So, one thing I want to just shift gears on. So, what are your thoughts on, accredited versus non-accredited in terms of investing in syndications and things like that?
I mean, being a little bit time tested here, if you're a non-accredited investor, you have no business investing in syndications and private placements. Just do what I did and buy little rental properties, get your net worth over $1 million, because there will be market corrections, right? Like you can underwrite conservatively, but what and usually conservative is like a 0.5% on going back to that reversion cap rate thing. If people are still following that thing, but normally industry standard for conservative, quote unquote, is a 0.5% increase in that reversion cap rate. So slightly worse market you're selling into. What we saw these markets correct 1.5%, so 3x that. So people who aren't following at home quite yet, it's like, you build a sandbag wall 10 feet up in the air, and that was pretty good for the last 3 Florida storms. But we saw a 30-foot tidal wave this last correction. Nobody predicted that. The institutions could not predict it. You know, maybe if you were a family office and you had 50, $100 million to throw at a deal, you could have outlasted, but nobody would have done that because it's not a good ROI for that new money. Um, but that will happen. But the idea is, get in when the getting's good and get yours in that time. And, markets.
I think that's a good way to look at it. If you are accredited, then definitely get in on these types of deals that when they make sense. But if you're not, just start to your point on the wealth elevator, one floor down, and get yourself a rental property. Make sure it cash flows so you can ride out any market turbulence, and build up your net worth, and then go from there. I think
And
that's a great way to look at it.
diversify over 4 to 7 years.
Yeah. Yeah, I like that. Um, so what would you say has been your biggest like mindset shift over the last or going into the future in terms of like how you're looking at um, protecting and growing your money into the future? Let's end on a positive note.
Yeah, I mean, for a lot of my clients, they're kind of getting to this end game level. I guess that would be like floor 3 or of the wealth elevator, which I would just say it's like 4 to 5 million net worth. At that point, you technically don't really need 15-20% IRR deals, right? So it's more about capital preservation or converting it into cash flow, whether you do some closed-end funds or life insurance at 5%, or more of a barbell approach where you take a small portion of your portfolio, keep it in alternatives, and keep it growing, or maybe even do some crazy angel investment, so asymmetric stuff. But the majority of your net worth is in, very stable stuff. Now, now we're getting into the world of, asset allocation, and I'm technically not allowed to talk to people because I don't have a certified financial planner license, and only they can do that apparently. But this is where everybody
Hypothetically
needs to,
speaking.
yeah, this is where everybody needs to kind of interact with other people in this alternative world and ask what they're doing. So what I'm doing, I like the barbell approach. So I like things in infinite banking policies and life insurance and maybe even some T-bills, but I'm going to take a portion of my net worth and try to hit some doubles and home runs with for outside returns.
Yeah, I like that. I think the barbell is a smart way to do it. Cool, man. Well, for those that want to learn more or connect with you, how can we do that?
Yeah, they can check out my book, The Wealth Elevator, on Amazon. If you guys buy it and send us a screenshot, we will send you the audio book and the electronic copy. Um, team at thewealthelevator.com. And yeah, thanks for having me, Oliver. Appreciate it.
Nice. Yeah, man, I appreciate you coming on and sharing some knowledge with us about how we can win with syndications and with, making money and preserving capital over the long run. And as always, guys, make sure you check out the links in the description. Leave us a 5-star review. And if you like money and you like real estate, hit that subscribe button and we'll see you on the next one. Thanks, Lane.
All right. Cool, Oliver. Take it easy, man. Good seeing you. Bye.